Hey Aaron, I figured I'll kind of do a demonstration, which is so much easier on YouTube, kind of talking about what we talked about to make it easier to understand how an asset is actually valued. And we talked about intrinsic value of an asset. And so, what I want to stress out is that there is a way of calculating any asset out there to find out its intrinsic value. So, like any asset, for example, my parents' house, it's worth more than $1, but it's worth less than 10 million. We know that. So if somebody came to you and said, "Hey, listen, I'll sell it to you for $1," it's a no-brainer. You'll buy it. If they come to you and say, "Hey, listen, I want 10 million for it," you're going to be like, "You're an idiot," and you're not going to buy it. But there is a point in which an actual dollar amount at which point that property is no longer worth buying and it's worth selling. If it's above that amount, it's worth selling it if you own it. If it's below that, it's worth buying it. And there's literally an actual dollar amount that you can figure out. Now, when you're buying an asset, obviously you want a margin of safety. So if you figure out that dollar amount, you might say, okay, if it's 5% below that dollar amount, I'll buy it, or 10%. That's exactly how Warren Buffett operates. When he's buying shares in a stock market, basically one thing he's learned is he doesn't look at the price of the stock in the stock market. He reads the news, he looks at the management team and what the company is doing, and he looks at their balance sheet and income statements, and he comes up with the whole valuation of the company and says, okay, this company is worth maybe 53.6 billion. And then he divides it by the amount of shares that are available, and he says, okay, well, this particular company is worth, $72.80 a share. And if he then checks the stock market price at what it's actually selling for between people, and if it's worth, $72, but on the market it's selling for $130, he's not going to buy it, right? And if he owned it, he would have sold it. If it's selling below that, he does the math and says, listen, this company is worth, 72 cents a share, but it's selling for $35. He goes, wow, I'm going to buy it because it's eventually going to come back at least to $72 a share, and I'll double my money. If it was selling at $70, he probably wouldn't buy it because it's not enough what he calls margin of safety. So he has to leave himself some room for error, some room for public panicking and making bad decisions. So he leaves himself a margin of safety, and there's enough stocks out there that he's able to pick out the ones that are 20% undervalued or more, or 30% undervalued or more. And the other thing too is he doesn't look at stocks when he's selling them. He doesn't try to estimate, well, how high can this stock go? He just basically holds it and holds it. If it's producing a dividend and it's worth holding, then it's worth the dividend, at least the amount of money that he invested per share. But if the stock goes well above what it's actually worth, then he goes, okay, I'm going to sell it because the amount of money that I'll receive for the shares is worth more than the dividend. And I can find myself a different dividend-paying stock that's undervalued. And he doesn't look at peaks. So, for example, he bought PetroChina back quite a few years ago, and I believe he invested about $500 million buying the shares, and he ended up selling it for $3.5 billion. So he got 7 times on his money. And then he was criticized by the community saying, oh, you could have held out and still got $5 billion. Well, a lot of people don't understand that when he sold it at $3.5 billion, the stock price was severely overvalued. Okay, he would never buy it at that price. He would have sold it even if it was less than that. It becomes very risky at that point where that asset is already so overvalued. At some point, it's going to have to come back down, and the higher it goes, the more risky it becomes, where there's a kind of a point of diminishing returns where the level of risk of it crashing before he gets a chance to sell it becomes greater than the additional amount of profit that could be gained. And even that, he claimed that he waited a little bit too long to sell PetroChina because it already got into very risky territory. And it's difficult to predict how irrational the public is going to be in buying up and buying up. And it's also somewhat difficult to predict how the variables are going to change by the government stepping up and putting in certain subsidies, right? Because that's always a major driving factor. Anyway, so I do want to talk about the fact that there is a price for every asset, whether it's a home, whether it's a stock, whether it's an entire company, whether it's a vehicle, etc. Anything that generates positive cash flow on an annual basis, it's fairly simple actually to calculate what the maximum dollar amount you can pay for a particular asset. It doesn't matter whether it's a house or a stock. The calculation method is about the same. The only thing is you got to take into consideration some of the risk that comes in play. Like, for example, stocks for some are considered more risky than real estate, but for some, real estate is considered more risky. So, for example, when you put $100,000 into the stock market and the stock market tanks 20%, well, you've just lost 20%, $20,000. But if you put $100,000 into real estate, say you put a down payment of $100,000, you buy $1 million home, okay, and that home goes down 20%, well, not only did you lose 100% of your investment, but now you're in debt and you owe an additional $100,000, so you lost 200% of your investment. So the risk is very different and has to be analyzed slightly in a different way, but the calculation of valuating the asset is about the same, right? Because you don't have to leverage real estate. You should, because that's pretty much the only way. If you don't leverage and buy your properties for cash, your return on investment would be so miserable that it would basically cover inflation. So leverage is very important in real estate. But whenever you have leverage and people can actually, buy 20 times more of that asset class than they would in stocks, well, then you're paying a premium. You're really paying a premium because there's 20 times the amount of money chasing those goods than there would be in the stock market, for example. But anyways, I don't want to go too much into that. This here is a sample I wanted to show. This is 5-year fixed mortgage rates for Canada. And I wanted to show basically, and 5-year mortgage rates are a little bit higher because those are fixed mortgage rates, but it's the majority of the product that most people buy. And you can see the times. And the number one thing that I want to show about this chart is that there is a correlation between the historical mortgage rates and real estate prices. And that's going to be in all asset classes, even stock market. When you look at that, it does the same thing. Now, there's also a correlation with inflation, which we may get into in another video. But it's important to understand that the number one driving factor when it comes to real estate price is interest rates. When interest rates go down, property prices go up. When interest rates go up, property prices go down. And if you look at all major metropolitan areas in the world, the same thing happens. Now, when it comes to Vancouver, a lot of people are like, well, Vancouver is different. And they do that in every city. Like in California, well, it's California. All the millionaires and billionaires and all the actors and everybody, all the cash buyers live in there. And it's not going to happen in California. And then in 2008, when the crash started, California was the hardest hit of all of the United States. And it's usually actually the areas where they have the most amount of cash buyers, where the most amount of money is pumped into those cities. We grow much larger housing bubbles, right? You can't grow a housing bubble unless you have money chasing and people overbidding against each other. And the housing bubble becomes so much bigger, compared to inflation, than smaller cities where there isn't as much cash buyers. But on the downturn, when the economy starts taking a hit and property prices start falling, it's actually the areas with the most amount of cash buyers, the most amount of money that get hit the hardest. And they get hit the hardest is because they've overinflated that market much more than any other market, and the amount that property prices have to fall is much greater than in smaller cities and smaller towns. So I want to now kind of explain to you how to value a very, very basic calculation to how to value an asset, and to kind of explain why real estate's affect property prices is because of the way people purchase homes. So young couples start off, they're renting a home, they're spending $2,000 a month renting a home, and they want to buy because everybody says, hey, we got to buy, we'd love to own our home. They make this their goal, they save money, and they want to buy a home. And when it's time to go purchase a home, how do they make their purchasing decisions? They don't go, hey, listen, we want to buy a house 10 times the size. What they're doing is they're saying, okay, we're paying $2,000 a month in rent. We're willing to continue paying $2,000 a month. And we want to get a house that will cost us monthly $2,000 a month. We don't want to pay more. We want to pay the same amount. And the real estate agent does a quick calculation and says, okay, with these interest rates, you're able to afford X amount of dollars to purchase a home. And then they go out and buy a home. Now, they're also not going to cut back and say, okay, we're going to buy a home half the size of the one we're living in. We want something comparable, right? And that's why it's important to understand that there's a very high correlation between rents and property values as well. So there's basically two factors. There's rents and there's interest rates and a little bit of inflation. Inflation affects interest rates. It doesn't actually affect the price right away, but the two major factors are the amount of dividend that you receive from the property, which is basically the rental income, and minus the expenses. Even if you're not going to rent out that property, you're still going to be comparing it to rent. Everybody does that. Even if you're not taking a mortgage and buying for cash, you still have to get some kind of return on investment that's greater than the bond markets, greater than the stock market, or at least equivalent. And therefore, if you're comparing to another house that you were living at and paying rent, and you move into this house, the numbers still have to make sense. Now, one more thing that I want to explain before I get further with this is that whether you're renting a home or you're buying a home, regardless, you're still renting. So in one scenario, a landlord buys a house as a package and they rent out that house to you. You don't sign any contracts. You can move in and out, maybe for a year. If you can't make your payments, you can leave and take very little consequences. When you're buying a home, the only thing different that you're doing is you're going to the bank and you're renting the money at a set fee, and then you're buying the home. The difference is you're taking a bigger risk. You're putting down a deposit. You're signing a very long-term contract. If you do change the contract, you're paying out of your deposit, fees. So it's a little more risky, but either way, you're renting something. Whether you're renting the money or you're renting the home, the only time that it actually makes sense to buy a home, okay, is if you're able to get it cheaper than the cost of renting. And in any normal market when there's no bubble, you can always get it cheaper. People buy homes, right, and rent them out to people like John, for example. What they do is they say, listen, I'm going to buy this home. Okay, I'm going to make the mortgage payments. I'm going to find the tenants. And if the tenant moves out, I'm going to find another tenant. There's a lot of people out there that are unstable enough to commit to a property. They move back and forth. They change jobs. They have downtimes for them, and they can't save up for a down payment. And the bank is not willing to lend to those people because they're going to buy a home. After 3 months, they'll be gone 6 months, just like tenants who move around. So landlords created a service by saying, listen, I'm going to put down a down payment. I'm going to deal and absorb all of the instabilities that the bank isn't willing to absorb. And I will maintain the property. I'll paint it up. I'll fix it up. I'll make sure it's all running. I'm going to find a tenant. If the tenant leaves, I'm going to find another tenant. If that one leaves, I'm going to keep finding another one. And meanwhile, I'm going to take money out of my job and I'm going to keep making this payment so that the bank has this perfect stability, right? But why would anybody do that? Why would any landlord in their right mind do that? And the only reason why they would do it is because they believe that they can mark it up, that they can buy this property, okay, put a tenant in there, charge them more than their cost, right, mark it up, and make profit off of it, right? They're trying to make some kind of markup, which means they have to receive more from the tenant than they're paying in rent, which is the fee they pay to the bank for renting the money. Because they have to be compensated for their time and also risk, right? And so generally, owning is cheaper than renting unless there's a bubble, right? Only during times of bubbles, owning a home is actually more expensive, much more expensive in some cases, but it's usually justified by the fact that most people believe that that property is going to be rising in value very fast, faster than the rate of inflation. Some people think it's forever. In all cases, it's not forever. It's for a period of time, and then there's a correction, and it comes back to the inflation line, and it eventually balances itself out. If this was a bubble and this was inflation, property prices would have gone up and they would have gone down. And in every scenario, the same thing has happened. So now I'm going to get rid of this, and I've made a basic calculator to show you an example. For example, on my dad's house. At peak, I think we were able to sell it about 750,000. Right now, I think about 600,000 would be the most, and I'm worried that it might be even less, 550 or less. One of our neighbors posted the house for 525,000, which is really going to screw us over. Somebody in the family got sick and they're looking to sell really quickly. Who knows what's going to happen? We're going to monitor to see if it sells quickly. If it does sell quickly, we can try to post our house for 600,000 or wait till the summer, hopefully with these reduced interest rates. Here I created a calculator, kind of what I was telling you. Our home, I think the maximum we could rent it out for, if we just rented out the whole thing, is about $2,000 a month. It's a 1,500 square foot townhouse, 3 bedrooms, 1.5 bathrooms. It's fairly nicely renovated, but I believe about $2,000 would be kind of the mid, maybe to top range. So we've talked about the fact that 5% of homes have, or most homes have about 5% vacancy. So actual money received is going to be $22,800 if we were to rent it out. And then we have I checked our property taxes were actually $180 per month. So it's $2,160 for the property tax. Our maintenance fee is $300 or $3,600 a year. And I put in about $2,000 a month for maintenance and repairs of the interior. I think this is grossly underestimated, but just to keep things simple and modest, we've done renovation that cost us like $40,000, and we've replaced the appliances 3 times. When you look at appliances in a house, when your tenants are renting, you're buying the appliances, you're changing them. An easy way to calculate the monthly or the yearly cost of appliances, the average appliance lasts about 7 years if you stretch it out. So you can just take the cost of appliances divided by 7. This leaves like, under $200 a month. I believe it's significantly higher than that. In fact, I know a lot of people that spend $50,000 on renovations. That's like 25 years of $2,000 a month payments alone. But okay, so annual expenses are about $7,760, leaving that property with just over $15,000 in positive cash flow. On top of that, you should probably reduce that amount because you're going to be doing a lot of the work yourself versus putting it in a stock market where you just put money in and you don't have to be there to repair vehicles in a company. The management and all that do that. You just take a percentage of the profit. But in a house, you have that additional time investment where you're going to have to react and do things. You might have to wake up at nighttime if there's an issue. As we're buying shares in a company, you won't have to do that. So I believe this should be discounted. But anyways, I want to tell you how much of a role interest rates play. When interest rates are low, people can buy a home for a much greater amount than they're able to when property prices or when interest rates are higher. So as an example, $15,000 is required. The maximum amount that you can pay on this house before you start not breaking even or losing money, is $15,000 a year, because the whole positive cash flow is $15,000. If you purchase it and your interest payment is $15,000 or greater, you're losing money. If you're purchasing it and your interest payment is lower than $15,000, you've got at least a little bit of positive cash flow. So if you look at this, if we had that $15,000 positive cash flow, okay, if interest rates were 1.5%, then the max that we can pay for this property is $1 million. You'd be like, hey, I can buy this for $1 million. I'm willing to pay that. Our house was at like $750,000. If interest rates went even lower to 1.5, it would probably be worth $1.5 million. But you'll notice if we change this to 2% interest rate, the payment would be about $20,000. And so how much could we pay for that property at that point? Not even $800,000. That devalues the property, okay, to about $750,000. So anyone coming in is going to say, listen, maximum mortgage payment is $750,000, because that's how people purchase real estate. Unfortunately, when you tell them $1 million, $10 million, $20 million, they don't really care. All they care about is how much is my payment going to be. Most people can't even picture $1 million or $750,000 or even comprehend what that would look like and how much purchasing power that would give them. All they care about is their mortgage payment. And here I did a calculation that just automatically adjusts the total valuation based on the interest rate to show you how much of a difference your property value changes when the interest rates change. And this is why when interest rates are going down, right, property prices go up. Just like we saw in this picture here, as interest rates went down, property prices went up. And the reversal happens when interest rates starts going back up. But you and I, we haven't been in an era where interest rates were going up. Because every time interest rates went down, let's take a look at this here again, every time the real estate market showed a little bit of crumbling problems, the government started cutting interest rates really quickly. And what happened? It reversed and it started going back up. When it started getting overinflamed, they bumped up the interest rates. And what happened? Property prices started falling. So what did they have to do? Start lowering interest rates even more, and going up and going up. And then here around the 2000, this is where the bubble actually really started. Interest rates kept going down gradually, but a lot of speculators started taking this on because they saw this chart, Real estate agents started showing them charts up to here. From here to here, they're like, look, real estate can only go up, and they would print out these like very biased charts, and a lot of speculators started coming in. When the speculators come in, then the prices go up, and it's even easier to show, hey, look, real estate only goes up and never comes down, and people buy into that shit. So anyways, let's take a look at my parents' property that would maximum bring in $15,000 positive cash flow as an investment. That's literally the most you can get out of that property. So what happens if we bring this up to 2%? That drops the price of the house to a maximum of $752,000. Okay, if it's 3%, that home is worth $500,000, which is actually pretty equivalent to where the interest rates are right now, and to what I believe our house would be worth. What happens if the interest rates go even higher? If they go back to 4%, the absolute maximum dollar amount an investor can pay is $376,000. You and I were talking, about the interest rates, average interest rates being 7%. I'm saying they were actually 8.5%. But let's just say 7%. Look what happens to the value of the house. $214,000 is the absolute most that someone would pay. If I saw that interest rates were 7%, and there was no reason over the next 5 to 10 years for interest rates to drop significantly, the absolute maximum dollar amount I would be able to pay for this property is $214,000. Actually, much less than that, probably $180,000, because you do need some positive cash flow. At 8.5%, okay, that property goes down to basically where we bought it. We bought it at $180,000. Now, there is obviously some compensation for inflation added, so I don't think our house is worth $276,000. I believe our house is actually worth about $220,000 to $250,000. Realistic, that's the intrinsic value. Yes, we can sell it for $600,000 right now. We could have sold it for $750,000, literally 3 times the amount that it's worth. But that's due to the speculation. Because of this heavy speculation, we were able to sell the house for 3 times the actual amount. And here's the problem: like, if you buy this house at 7%. For $214,000, you are breaking even on the investment. You have no positive cash flow. So it's still a horrible investment, right? It's a completely horrible investment, because why would you get into an investment that doesn't give you any positive cash flow, and you're taking so much risk? You're putting down a down payment. You're waking up at nighttime if there's an emergency. But that's what your payment would be. So if the house was $750,000. Okay, or sorry, $214,000. Okay, and the interest rate was 7%. That means your mortgage payment, right? Your interest payment, your annual liability for interest, would be about $15,000, right? So no one would come in and pay more if they had to buy this property for $400,000. They'd be paying $30,000 a year in interest, right? And if they bought it for $600,000, they'd be paying like $45,000 a year in interest. It doesn't make sense on a property you can rent for $2,000, and the landlord pays the maintenance fee. The landlord pays for all your maintenance and everything else. And that's how people have bought homes. So when interest rates were, like 7%, yeah, these homes were going for $114,000. Our house was going for $180,000, right? But then every time the government cut the interest rates, people were able to spend more money on that property. Okay, then it went down to 6%. The next buyer was able to buy it for $250,000 and still pay $2,000 a month, right? Plus, you get a little bit of inflation where people's incomes are growing, so you're tacking on a little bit of that, which we had like inflation rates of 5% around that time. And it keeps going, 5.5, and then eventually interest rates went down to 5%. Now all of a sudden this $180,000 house was selling for $300,000. It was like almost double, right? And then 4.5, or sorry, they were going up. Yeah, 4.5, they dropped it. All of a sudden 300 some thousand, right? 4%, almost 400,000. 3.5%. All of a sudden it's getting into 429,000. And when you actually review interest rates and the correlation between housing prices, you're going to see that these numbers are almost dead on. Almost dead on. Still, every one of those numbers I give you here, the monthly payment is still $2,000 a month, right? It's still, or at least $15,000 a year. So the payment doesn't change. All that changes is the interest rate and the total value of the house. So 3% goes up to 500,000, 2.5% goes up to 600,000, sort of where we are right now. And where now it's lower actually, but with this pandemic going on, I don't know if I can really look at the interest rates having that much impact. But at 2.5%, I felt our house is worth about 600,000. At 7%, it's worth this much. And the reversal is happening. So keep that in mind. Now, the other thing to keep in mind, we can talk about how a bank lends out money. And that's a little bit more difficult. As I mentioned before, if a bank charges 8.5% interest, okay, and the inflation is 3.5%, and their overhead costs for the bank are 2%, that means out of that 8.5%, 5.5% of that, okay, is cost, is the bank's cost. So the profit is actually 3% is their profit. And we're getting mortgage rates now less than what the profit would be in a bank, but most people do not understand the reason why, how this is possible. If a bank was able to charge 8.5% interest before, and now they're charging 2%, under 2%, how is it that they could still be profitable? Well, the important part to understand is that somebody is subsidizing these interest rates. Somebody is subsidizing that fee for any homeowner, anyone that has a mortgage. And the way they're doing that, there's two ways. You can borrow the money from China, okay? And if we look at our debt, ever since interest rates came down, the debt has been skyrocketing. So which means that we have been borrowing money from China, okay, in order to keep our interest rates low. This is not sustainable. If we kept doing that for years and years and years, we'd bankrupt our entire economy, because at the end of the day, we're not going to be able to pay those debts. We're going to have to print the money, right? So there's two ways that the government can fund. Even right now, all this money and bailouts they're putting in, it's either borrowing money or printing money. But at the end of the day, it always comes down to printing, because even if we borrow all this debt, we can almost never pay it back, because we'd have to come to a point where we're no longer borrowing the money that we're borrowing, but now we start paying back. That's a hard transition. So usually governments end up just printing their way out of debt, which means that we get higher rates of inflation. And every time the government is forced to print a large amount of money, we are hit with the ultimate penalty for all this. The ultimate penalty for this coronavirus funding right now, at the end of the day, is high rates of inflation. And if this inflation right here goes up to 12%, okay, and the bank has a cost of 12% plus an additional cost of overhead cost of 2%, right? And they still have to make a profit, so their cost is 14%. They're going to lend out at 17, 18%, They don't have a choice. Anything below 14%, they'll just stop lending money out, and debt will freeze up, unless the central banks step up and say, hey, listen, we need you to lend money below cost, and we're going to give you the difference. Where are we going to get the money? Well, we're trying to get it from the taxpayer, but the tax fund is freezing up because people don't have the money. So what do? We either borrow it from China or we print it, right? And when you print more, you get even higher inflation. And when you look at certain countries, for example, Germany, when they started the war, during wartime, they thought it's going to be easy, boom, boom, boom. They thought they're going to, take over some countries and win, but they realized that they had a lot of resistance. And once they were stuck in it, they were forced to have to basically print their way out of this. So if we look at some pictures from the Great Depression, no, not the Great Depression, Germany. Yeah, actually. Okay, look at some images. There used to be images online. Okay, these are famous images of people actually burning money in their stoves because the value of the money was cheaper than the cost of buying wood. And kids were playing with the money because there was so much money printed in the economy that this whole stack was worth probably 10 cents or 5 cents or maybe even a fraction of a penny. And you can see the inflation here, what happened in Germany when they started printing money from something that used to cost $10, would cost, $1 trillion at one point. So the money devalued to fractions of zeros. You see the same thing in Zimbabwe when they couldn't handle when they started printing too much money to get themselves out of the mess uncontrollably, the rate of inflation shot up. Unfortunately, our government is right now stuck in a situation where the real estate market's been in a bubble for a long time. They've deferred it by cutting interest rates every time it was about to pop, ever since 2008, even before that actually. And we're now at 0.75% interest rates. They've got very few bullets in their chamber, and it's coming to an end. There are possibilities of them doing something called negative interest rates, which I believe we're going to see. We will see 0% interest rates fairly quickly here with this coronavirus. And after that, I'm pretty sure the government's going to consider negative interest rates, where we're actually being compensated for carrying a mortgage. It's kind of insane. But that's the only way to prevent the housing market from crashing at the same time as the coronavirus, at the same time that we may be having a recession. It's better for the government to even create such silly scenarios as negative interest rates and defer. They can't stop this crash from happening, but what they can do is they can defer it. And once the coronavirus thing dies off, the economy starts coming back, and we're not in a recession, then allow the housing market to start deflating for 7, 8, 9 years. It would be significantly less painful for the economy and for the public than having all three of those things go off at the same time, because that could technically create a depression. And it's very, very hard to get out of those depressions. I mean, governments can print trillions of dollars, inject into the economy, and oftentimes even that isn't enough. So just a brief video. If you have any more questions, I can kind of go through more detail. But keep in mind, this is a simple calculation. All you do is you take 7, you take the amount, right, divide it by 7 times 100, or this amount, your positive cash flow that you can bring in, divide it by 7 times 100, and that will tell you the total value of the asset, that basically what you can pay for. Now, I know you might say, your mortgage goes down over time, but I'm just looking at the interest payment. So your mortgage can vary. You can do a 5-year mortgage, 30-year mortgage. You can have a 30-year mortgage and keep refinancing and keep taking out. But I'm looking at just the cost of borrowing. Anything on top of that you pay goes towards your equity in your house. But I'm considering that you're just paying interest, right? Because that portion can be adjusted. So you can have a 1-year mortgage and make pay $100,000 a month until you pay off your home. You're still paying the same amount of interest every month, at least for the first few months. But you're putting so much more towards the principal of your house, and that's your choice how much you want to put towards the principal. I'm just looking at the break-even cost. Anyways, I hope this helps. If you have any more questions, I can come up with some more videos or even in person. This is kind of nice because it's visual. It's easy to explain. And a lot of the questions you're asking, I'm getting asked by quite a few other people. So it'll be easy for me just to send them a link and say, you know what, I've already answered this question. Here you go. But yeah, anyways, it was nice talking to you, nice catching up, and I'll see you later. Good luck.